Just to let you know, our first exam is coming up next week. We're going to be having it on Monday. So it's going to include chapters 1 through 4. There will be review session. We're going to finish off chapter 4 come Wednesday, and then either Thursday evening at 7:30 or 9:30 on Friday morning or 11:30 during your normal class time on Friday. We'll be doing a review session for the exam, which will be on Monday. That's a week from today. As I said, chapters 1 through 4 will be covered, but at the review sessions, I ask that you come with questions. Rather than me saying, here's what's on the test, because I can tell you it's chapters 1 through 4, I want to come up with things that you don't find clear, things that you are finding challenging and you want to review. So for our review sessions, either Thursday night at 7:30 or Friday morning during class time, 9:30, 11:30, come with questions, things that might not be clear, things that you want clarified. If you want some other exercises added for 0 points, so you don't have to worry about mandatory credits in the Connect, I can add some questions and answers and some other opportunities for review. And you've got plenty of videos. You've got my recorded chapter videos, you have these individual class recordings videos, and you have the Ben and Boz videos. So you will be ready for Monday. The Monday exam on chapters 1 through 4 will be styled mostly like the quizzes, because it'll be through Connect, but we'll also have some fill-ins and some things and some of the like more like the homework worksheets that you've worked on. So the content will include all of the first 4 chapters. No time will be wasted, as you will have a cumulative final exam. On that exam will include chapters 1 through 4, plus a whole lot more. So the exam for Monday, the review sessions for Thursday night at 7:30 or Friday morning during class times will all be worthwhile and reinforced. And it's not something you can just say, let me take the exam, get it out of the way, and let's go on to the next stuff. It will be part of a cumulative final. So none of this knowledge and learning will be wasted. Want to see if you have any additional questions at this point in time. Hearing none, we'll continue on chapter 4. Again, I'm more than willing to set up individual times or other questions that you might have to review stuff for the exam. My Calendly links only work basically 9 to 5 daily, but if you want to meet evenings or weekends, I'm available as well. So we'll find time to get together on your schedule if you have some questions or you want some follow-up. So we're here to serve and make it work. All right, let's go ahead and take a look at, just want to do a quick wrap up on chapter 3. There's something called the worksheet. And I'm going to go ahead and share. Actually, I'm going to refine this share to include the advanced, which is just a portion of the screen. And when you look here, you're going to see you got familiar with this adjusted trial balance. You got familiar with the columns for adjustments, the columns for the adjusted trial balance, the columns for the income statement, the columns for the balance sheet. And basically, when we end it all, we're going to end up with our permanent accounts standing as they are, and our temporary accounts like income, like revenues and expenses, being zeroed out. And the process of using this worksheet is we start with our unadjusted trial balance, enter the adjustments, prepare the adjusted trial balance, then we go after the financial statements. And it's the chart, the trial balance is in order, chart of accounts list from assets, liabilities, equity, revenues, and expenses. That's a pretty clean flow of what we've done. That's kind of the conclusion for chapter 3. So I do want to get into chapter 4, which is also going to be a chance to reinforce some of these things. We'll start talking about sales discounts. We'll start talking about merchandising companies. We'll be talking about the kind of folks and the kind of entries that go along with that. So let's go ahead and go into our patch over to our merchandiser. What are we doing when we're talking about a merchandiser? Well, we're talking about a retailer or a wholesaler, somebody that's buys stuff and resells stuff. Let me get the screen matched so you can see in full perspective of where we're going with this. So if you look at the formula down here, you've seen this income statement format before. Net sales minus cost of sales or cost of goods sold equals our gross profit. Okay, so that's based on the stuff we sell, the costs associated with those things we sell. And then we have our SG&A, selling, general and administrative expenses or other expenses. And we get our bottom line, which is either net income, net profit, net earnings, don't care what you call it, it's all the same thing. It all fits together the same way. And that's our profit we're looking at. But we have two kinds of income statements we look at. We have what's called a multi-step income statement, and I'll type that in over here. Got a multi-step, which includes a gross profit, which includes a cost of goods sold, which breaks down a little further than a single step. The single step puts all the revenues in one place, all the expenses in another, and calculates net income. So what's nice about being able to look at a multi-step, it gives you some more information, a little more details. And I'm going to ask you for my attendance question for the day. Please calculate the gross profit percentage of our multi-step income statement. Now let's see, we have gross profit of 5,317. We have net sales, and I'm going to emphasize the word net here because that's going to be important to us. We have net sales of 14,757. So take out a calculator, do it in the head if you can, but please put in the chat the gross profit percentage, that 5,317 divided by the 14,757. Tell me what you get. So we're looking at about 36%, 36.0%. Someone calculated the cost of goods sold percentage, which is a good question to answer. That'd be 94.40 divided by 14.7. But we want the gross profit percentage. So if you look at those two numbers, we got 64%. For every dollar of sales, the stuff we sell costs us 64 cents, and the gross profit is 36 cents. We don't take away our other selling, general, administrative expenses yet. We're going to have 36 cents for every buck of sales. I'm going to ask you to calculate one more thing. What's my net income percentage as a percentage of net sales? So we calculated for every dollar we sell, 36 cents goes into our pocket to pay for the goods we sold. Now we're going to deduct all those other expenses, the 49.63, and get to 354. So when you take that 354 divided by the 14,757, what do you get? So if you recall, we did Walmart, and for every dollar sales, we put 3 or 4 cents in our pocket. With Nordstrom's, another retailer, a high-end retailer, I'm getting 2.4%. And I like that because that's what it is, 354 divided by 14,757. So every dollar of sales, Nordstrom is putting 2.4 cents in their pocket after all their expenses, after they pay the rent, after they take care of depreciation, after they take care of their wages, after they take care of utilities, after they take care of equipment and other related expenses, selling, marketing, advertising. All that stuff comes out, and bottom line, they're putting 2.4 cents in their pocket. Now, is that good or bad? We all know the answer to that. It depends. If Nordstrom was 4 cents last year and 2.4 this year, that's pretty lousy. If they're 1% last year and 2.4% this year, that's pretty good. If you're trying to compare them to Walmart at 3.5% versus 2.4, not as good. So again, it's all relative. All these ratios are relative, but it's also nice to be able to see in a summary way what those percentages are, what those numbers look like. So let's keep going through and process down. So we're going to look at some cost flow and analysis here. We've talked about the operating cycle. We buy stuff, we sell stuff, and collect the money for it. That's the cycle. Now, if you're a manufacturer, you buy stuff, you make stuff, you sell it and collect the money. If you are a retailer or a wholesaler or what's called a merchandiser, you're buying stuff for resale, whether you sell it wholesale or retail, you're buying it for resale, you cycle it through and you're selling it. Once you collect the receivables, you're done. So that's what we talk about when we mean operating cycle. Now, there's another formula I'm going to show to you. You remember your retained earnings formula, but we're going to do something about beginning inventory. We got beginning inventory. We're going to add to that purchases. We're going to buy some stuff. And we're going to end up with something called goods available for sale. Now, when we look at that, everything we have the potential to sell is included in that gas line. And then we subtract cost of goods sold, we're going to get with ending inventory. Or we're going to subtract ending inventory and end up with cost of goods sold. So what is this telling me? This is telling me we bought a whole bunch of stuff and we now either sold it or it's still here. It's one of two places. So if we sold it, it's cost of goods sold. If it's still here, it's an ending inventory. But cost of goods sold plus ending inventory must equal the goods available for sale. The picture here shows a little more graceful. Beginning inventory plus net purchases equals merchandise available for sale. And then you've got your stuff available for sale. You either sell it or it's still here. Those are the two things that can happen. It's either going to show up on your income statement as cost of goods sold, debit balance, or it's going to show up on your balance sheet as an asset, debit balance. Those are the only two places it can be. We'll talk about shrinkage in a minute. Sometimes things get stolen, they disappear. We're going to consider that sold for $0, but that's another story. But I want you to make sure you understand this basic inventory formula because it's kind of important. It's kind of a way to see what's going on with all the stuff we get. We had some stuff, we bought some stuff, and then we have merchandise available for sale. We sold some stuff and we have ending inventory. Last month's ending inventory, though, becomes this month's beginning inventory. So the cycle goes on. This goes into the asset section, and this ends up on the income statement. So pretty cut and dry, pretty direct. It's either going to show up in the balance sheet as an asset, it's going to show up in the income statement as cost of goods sold. It's going to start out in inventory plus purchases. And that's where we're going to be. All right, let's keep going onward and upward. We've got two types of inventory systems we're worrying about. We've got the perpetual, which we update every time we make a sale, and the periodic, which we update at the end of a time period. We're going to be emphasizing the periodic. Okay. Perpetual systems are kind of nice. I'm selling cars, boats, diamond rings. I can sell that car for that much money, and I can calculate a gross profit. Update the records right away as we sell things. But if we're selling bushels of apples, heads of lettuce, boxes of cereal, we're most likely wanting to go to the end of the period and figure out, well, how much of this have we sold? What's revenue? And it could be the end of a day. It could be the end of a week, could be the end of a month. So we're going to go through and focus on periodic, but we're going to talk about perpetual as well when it comes to inventory tracking. So let's go sell some stuff. And there's something they're talking about called cash discounts. And we'll talk about cash discounts in a minute. But we're not talking anything with discounts. We're doing COD here. Cash on delivery. We sold some inventory. We got some cash. You go to Walmart, you go to McDonald's, you go to Wendy's, you're paying right away. That's COD, cash on delivery. Okay. So what's the journal entry look like? Well, we're buying stock. This does not affect the income statement at all, does it? Merchandise inventory is an asset. Cash is an asset. So one asset up, one asset down. We got a net asset change of zip. We increased our assets, we decreased our assets, and the net effect is zero. Well, let's go one step further. Let's go buy something on terms. We're going to buy something that we owe the money. We're not going to pay cash for. So we're still going to have our $500 in inventory, but instead of cash being credited, which reduces cash, accounts payable is being credited, which increases payables. So our assets went up $500. Our liabilities and equity went up $500. We're still in balance. Life is good. But now we're introducing something called a terms code. And what is this 210 net 30 all about? Well, we actually just talked about COD. That was cash on delivery. We got things like 210 net 30. We could do a 110 net 5. We could do a net 15. We could do a net 30. So what the heck does all this mean? Well, net is pretty self-explanatory. I send you the bill, it's due in 15 days. That's our net 15. I send you the bill, it's due in 30 days. Please pay. 30 days. I'm not going to send you a bill. I want the cash now. COD, cash on delivery. But now we look at this 210 net 30. And we take a 2% discount if you pay within 10 days. Otherwise, pay the balance in 30. So in the chat, I'm going to ask you a question. What is 2% of $500? In the chat, calculate 2% of $500. That's how much that's the net of what we're going to pay if we pay it within 10 days. We're going to deduct that amount from the total. So 2%, so 20% of 500. Oh, that's 20% easy. That's 100. So 2%, I move that decimal over. You're right on. You're getting 10 out of this deal. Okay. So you would pay $490. Perfect. Well said. But what happens? We're going to have to relieve accounts payable of $500 because we're never going to see that $10. This is known as a purchase discount. We're going to have sales discount and purchase discounts when we're buying stuff. We're going to take $10 off and our net is going to be paying $490. Well said. So let's see what that looks like in just a little clearer slide than what I gave you. So 210 net 30, that's how we say it. You get a 2% discount if you pay within the 10-day period, or you pay the whole balance in 30 days. So instead of paying $500, you're going to pay $490. Well, that's $10 difference. I'm going to ask you, should you take advantage of that $10? Go ahead in the chat and tell me, do you think that's worthwhile taking advantage of? It's only $10. No, don't bother. Or $10 is $10. I'd rather have it in my pocket than my vendor's pocket. And yes, it depends. If you don't have the money, you can't pay it. But 9 times out of 10 or 98% of the time, you want to take that discount. I will tell you, we'll worry about translating this later. That's 36% return on your money by saving $10. By not having to pay $10, you just made 36% annual interest rate. Is that a pretty good interest rate? I think so. Even you go into a bank account, you make 1% if you're lucky these days. Apple makes 22, 23% return on sales. That's a net income percentage. So is a 36% return? Yeah, that's a pretty good interest rate. You'd be hard pressed to get a better return without taking discounts like that. So usually it's advantageous to take the discounts. And again, 1.5 net 15 means 1% if you pay within 5 days, and or the balance is due in 15 days. Okay, 110 net 15. This is 210 net 30. That's more like a 24% interest rate, but still, it's pretty strong. This is still 36%. If it was net 45, we'd be talking something else. Okay. So this is the discount we're taking. Now we're going to have to do some fancy journal entering because we're going to relieve our payable for $500. We can't relieve it for $490 and leave $10 on the books that we owe the money. So this is actually a little more graphic representation of the discount period that 10 days, and the credit period 30. So you got a 20-day slack here. You're going to get financing for 20 days of what you're going to be able to pay. Here's an invoice. It has the date, has the terms on it, has the balance due, has shipping information, has all kinds of information on it. But terms code is kind of important. There's an FOB code we're going to talk about shortly. I want to make you aware of it though. FOB destination. There's FOB shipping point, FOB destination. We'll see that momentarily. All right. So if we go take a look and say, how do we handle the accounting? Well, we get paid. We just determined we're paying $490 in cash. So we're going to credit $490 in cash. Cash goes down. We're going to reduce our accounts payable, which has a $500 credit balance. We're going to reduce 100% of it. So whatever we're talking about, whatever we're working on, this $10 is going to be credited. I don't know what the account is yet, but you all will all know very shortly. But I do know I've got 500. I got a debit here. I got 490. I got a credit there. That's leaving me 10 that I have to credit somewhere. And you say, wait a minute. I originally put this into inventory, didn't I? When I bought this stuff, I went ahead and let's go see where it was. I went in and I made my journal entry. Yep, $500. I credited payables. I debited inventory. I put it in inventory. If I save some cash and I just save $10 in cash, I'm going to take that $10 out of inventory. There's not a purchase discount account here. I'm just going in and saying, I'm going to adjust my inventory because now the value of my inventory is $490. Because I'm not paying $500 for that inventory. I'm only paying $490. We'll see the same thing happens to shipping costs. We're going to have to put shipping costs in inventory too. But I want to introduce that to you. But you look at this and say, okay, I'm clearing my accounts payable for $500. I put $500 November 2nd. 10 days later, I take $500 out. I'm only paying cash at $490. There's my $490. And my merchandise inventory is being reduced or credited by $10. So my inventory is going to show $490 because that's all I paid. I can't put $500 in inventory for stuff that I paid a net of $490 for. So what happens after the discount period? We pay that $500 in cash, not $490, but $500. So what's going to happen? $500 out the door, $500 on its way. Payables off $500, cash off $500. Inventory stays at $500. We're not adjusting inventory at all. Any questions so far? Are we on the same page? Are we kind of making sense? So we're taking some discounts. Now, we've also got something called returns and allowances. So by the way, I want to make sure you're aware that discounts refer to cash discounts only. We're not discounting. You think of a discount when you go to the store. Oh yeah, I got 5% off, 20% off, 30% off over Kohl's. That's not the discount. A cash discount is specific in accounting. And so what we're working here is a cash discount. But we also have something called returns and allowances. If the goods are returned, we bought something and we return it. That's no longer in our inventory. Nor do we owe the money on that. We're going to deduct it from the payable. Or there's something called an allowance. Okay. So the allowance means we're going to give a discount, a price break. So let's say we go in. So let's talk about allowances for a minute. Let's say we're at Best Buy and we buy a fridge for delivery. And they come out to our house and they say, here's your new fridge. Congratulations, $1,000. Appreciate your business. And you look and say, wait a minute, there's this big gash on the side. I don't want this fridge. It's defective. It's coming back. It's coming damaged. I want to return it. So the delivery folks get on the horn with Best Buy and said, we got this fridge. It's damaged. What do you want to do? What would you say if Best Buy said, I'm going to give you a $100 discount. You keep the fridge. Okay, instead of $1,000, I'm going to give you $100 cash back or $200 in credit. You say, you know what? That gash is on the side of the fridge. That's going against the wall. No one's going to see it. For $100, I'll keep the fridge. Thank you very much. That's considered an allowance. Again, not a discount. and it's not a return, you're not returning it, but you're being granted an allowance. That $100 Best Buy is never going to see. They saw it for a minute, they got the $1,000 you paid, but they're giving you $100 back. Now you might say, well, you know what, the scratch on the side would probably mean the thing fell over and it's damaged and it's going to not have as long a life. I don't want anything to do with it. And that's okay too. You just say, take it back. I don't want it, it's yours. But if you agree to save it and hang on to it, that's going to save a whole bunch of hassle for you to go out and get another fridge delivered next day when you want cold food. And it's going to save Best Buy the hassle of taking the fridge back, sending it back to the manufacturer or trying to fix it, and then putting it back on the floor and selling it. A return they can put on the floor right away. You can say, you know what? I just bought this video game. I just got this TV set. It's in the box. I'm taking it back. They'll just put it back on the shelf or in the warehouse. But an allowance is you're keeping the goods and you're being paid to do so. So let's see how some of that stuff works. So purchase allowance, okay? Allowance for defective merchandise. So there's a $30 allowance. They say, you know what? And I just had, I got a dog leash. It was the wrong size. I went to return it. It was Walmart.com. And the manufacturer said, tell you what, if you cancel your return, because we get dinged every time Walmart gets a return, you cancel your return, we'll send you the right size and you keep the other one too. I don't have to send it back. Now, it doesn't do me any good. It doesn't fit my dog. On the other hand, I did cancel it and because they promised to send me another one and they did. And so now I've got the right size leash for my dog and we're back in business. It was easier for them to give me that and say, here, don't send it back. Don't hassle it. Don't bother. For them to say, just keep the leash and be done with it. Or the harness. It was actually a harness that attaches to a leash. So here's the accounts payable. And again, it's $30 less. I don't owe the money. And inventory goes down $30 in this case. 30 debit memo and debit to payables, as opposed to a credit memo to receivables, but we'll worry about that later. So on the same page, it's coming out of inventory. Eventually, this goes to cost of goods sold, but it's not there yet. So let's go ahead and take a look at our cycle here. So $250 worth of inventory was purchased. Terms were 210, that's 60. Okay, this is a little bit less than our 36%, but it still pays to take advantage of it. We're financing for 50 days. Accounts payable, we returned some goods. This is actual physical return. We returned $50 worth of goods. Now we owe $200. We're going to calculate that 2%, not on 250. We have to calculate that 2% on the $400. I'm sorry, the $200 that we owe. We can't take discounts on stuff that we returned. So we're going to calculate the $4 or 2% based on that 200. This $4 doesn't sound like a lot of money, but it's still well worth our effort to take advantage of the discount. And we're only going to pay $196 in cash. Okay. Let's discuss something called FOB. FOB stands for free on board. Important concept. Because when you buy something, I used to sell Chrysler, Jeep, and Kia. I used to sell cars. And I want to say there's Kia USA and there's Kia South Korea. Kia South Korea sells to Kia USA. So who owns the goods in transit? Well, let me give you an example. In the middle of the South China Sea, there is a boat at the bottom. The boat contains a bunch of Kia SUVs, sport utility vehicles, sport utes. They are kind of waterlogged right now because the boat sank. Who is responsible for those SUVs sitting in the deep of the South China Sea? Well, the answer is, as you probably guessed by now, is it depends. Were the goods shipped FOB shipping point or FOB destination? If they were FOB shipping point, the inventory will belong to the buyer once the material leaves shipping point. So if this came out of Busan Harbor, which I've actually been to in South Korea, and this is coming to Los Angeles Harbor, if this is in transit, the buyer is responsible for the insurance, for the shipping, for hassling and making sure they collect on the insurance and do whatever they want to salvage if they can get divers to go into the South China Sea and salvage what they can. If it's FOB destination, the seller is responsible for contracting for shipping, paying the bills, taking the insurance, and all that good stuff to go with it. Now, how about if all this worked out fine, but it came into port on January 8th and was shipped on December 2nd? Nice slow boat to China, or to Korea rather. So we have inventory. If it's FOB shipping point, the inventory belongs to the buyer once it leaves. If it's FOB destination, it belongs to the seller until it gets there. So just because you do not have inventory on the shelf doesn't mean you're not responsible for including inventory on your books. And we'll do a little more practice with this. We'll do a little more reading on it. But I want to make sure you understand that, because on the invoice that we had, you see this little term here, FOB destination. That means the seller is going to pick it up in inventory. If on January 1st it's still in transit, the seller is still responsible. If the goods are hijacked and don't make it to the buyer, the seller is responsible for the insurance, the shipping, and all that good stuff to go with it. So FOB is kind of an important concept. We'll talk about consignment goods another time as well. So just because it's not on the shelf doesn't mean you don't have additional inventory. And also, just because it is on the shelf doesn't mean it's your inventory. A lot of bread makers, even Pepsi, potato chip makers, they will put stuff on the shelf at a retail grocery store and not have that owned by the grocery store. That's still owned by Pepsi, by PepsiCo. And then when it gets sold, it becomes cost of goods sold, and Pepsi gets credit, and they get paid for whatever's not on the shelf. That's why you see all these Pepsi reps and trucks going there. Pepsi is stocking the shelves. Coca-Cola is stocking the shelves, not Walmart, not Sam's, not Costco, not IGA. Okay. So this consignment stuff we'll talk more about too down the road. All right. So let's talk about transportation costs. The same thing about who's responsible for insurance is who's responsible for transportation. And if we're looking at this, FOB shipping point. So if we have stuff starting here, it now belongs to the buyer, it becomes inventoriable cost. They pay their shipping costs, it gets added inventory. So if you buy something for $500 and there's $50 in shipping, you now have $550 in inventory. You're not going to have a shipping freight in, freight out, or whatever on your books. You're going to just have it added to inventory. On the other hand, if FOB destination, there is going to be a freight out, what they call delivery expense, for the seller. So the buyer puts it in inventory if it's FOB shipping point. If it's FOB destination, the seller puts it into freight out or delivery expense. So it kind of be a little bit confusing if, again, not having done this before, but realize that this FOB term is kind of important to realize, do I record this as inventory if I'm a buyer? Do I have to show it on my books? Do I have to include it in the month end or year end financials that say I own this inventory? Or is a seller owning this inventory? Both can't own it, by the way. It's either one or the other. And it depends on its FOB shipping point or if it's FOB destination. Okay. So what happens? Transportation costs, FOB shipping point. The buyer is responsible. So remember, the shipping point was over here, and now the buyer is responsible for the inventory. So the transportation charge of $75 goes into inventory, becomes part of the buyer's inventory. On the other hand, if it's FOB destination, it becomes a cost, a transportation expense, a transportation out expense for the seller. So what goes on if we're looking at inventory, we've got the merchandise we bought, $235.8. We got the purchase discounts that we received. So there's our 210 net 30 or 210 net 60, whatever it was. We got the purchase items and allowances, 1,500 returns and allowances. And then we have transportation in. So all of this stuff is going to go into inventory. That's an inventoriable cost for the buyer. Okay. And let me clear that out. So let's go ahead and we'll do this perpetual inventory stuff. So we have net sales, cost of goods sold. Notice the term net here. I'm going to emphasize that right now. Our net number is 100% number. Our gross number before R&A, before sales discounts, might be 103% or 105%. But if we're not going to collect the cash, if we gave a sales discount or a purchase earned a purchase discount, well, in this case, it's sales, a sales discount, we're never going to see that cash. If we had a return, the customer returned the goods to us, we're never going to see that cash. It was not a sale. If we gave them an allowance, we gave $100 off on the fridge, we're not going to see that $100. That's not a sale. That's why the net sales is our 100% number, not the gross sales. I made this mistake when I first got out of school and I was doing some calculations and some vertical analysis. And I used the top number, sales, as my 100% number. And then I had net sales, and that was like 97%. And I got that wrong in business. All right. I screwed up. I fixed it really quickly. Never made that mistake again. I learned more from my failures and mistakes than I have from my successes, but hopefully you don't have those failures and you don't have to learn the way I did. All right. So let's keep going. And let's talk about our merchandise sales. So each sale transaction, two parts. We get revenue in the form of an asset from a customer, there's our inventory, or we have a cost of goods sold of what we sold to the customer. It's either an asset that's a debit balance, or it's a cost of goods sold as a debit balance when we buy stuff. Those are the only two things we can do. Okay. Here's our sales without a cash discount. Sales receivables. Now, remember we talked about our double entry accounting becoming quadruple entry accounting? 4 times the fund instead of double the fund. So we have the sale here of $1,000 and the receivable of $1,000. And we have the cost of goods sold, the expense associated with that sale of 300 and our inventory coming out of 300. So we have a gross profit of 700. I hope you didn't need a calculator for that. But you get the idea of, okay, so we have to record the sale like that and the cost of goods sold to go with it. Sales discounts, just like purchase discounts. We use the same 210 net 30, 210 net 45, 15 net 15. Okay. So what happens? 210 net 45 here. Here's the sale, $1,000, $1,000, 300, 300. Now we are generating a receivable. We got cash, sales discount, if they pay within the discount period. We have $1,000 in receivables up here. And we have $1,000 in receivables we need to clear there. Now they don't owe us anything. We only collect 2% discount, that's $20. We only collected $980. We have to debit something for 20. And the debit is going to sales discounts. Again, this is cash discounts only, not discounts because the goods were bad, not discounts because we put it on sale. It's a cash discount. That's what we mean by discounts here. Okay. So there's returns and allowances, and there's discounts. This is a case of cash discount, 2% according to the terms. If there was no discount taken, $1,000 cash, $1,000 receivable, we're on our way. Okay, so sales, returns, and allowances are like purchase returns and allowances. Returns refer to merchandise that customer returns to the seller after a sale, and sales allowance are reductions in the selling price of stuff that was already sold. So we took a $100 discount, $100, I use the term discount, I'm sorry about that. A $100 allowance, not a discount, sales discounts are cash only, a $100 allowance for not having to send the goods back. Or we would have taken 100% of the return. So what happens? A customer returns $15 worth of merchandise that costs $9. So there's a partial return. Returns and allowances, $15, cash, $15. If it's not defective, it goes straight back into inventory at the cost, $9. And cost of goods sold is reduced by $9 because we didn't sell it anymore. It's not sold yet. Or if we determine it is defective, but there's still only $2 value to the inventory, we'll put $2 worth of inventory in there and we take a $7 loss out of the gate and reduce our cost of goods sold by the full $9 that we increased it for before. The allowance, these are returns and allowances. Again, $40 of merchandise sold on November, it's effective, but the buyer decides to keep it because they offered a 25% reduction, a 10%, a $10 reduction. So $10 debit returns and allowances. And again, this shows up on the income statement. Our returns and allowance is a contra revenue account. It's an offset. It's got a debit balance. Normally revenue has a credit balance, right? So if you look at our credits, debits, we got our revenue here. We've got our cost of goods sold here. We've got our expenses here, SG&A, but this is a credit balance. Our returns and allowances, our sales discounts, those are all debit balances. They're a reduction of net reduction of revenue. Okay, that's how we get to our net revenues, net sales. All right, so let's go take a look. Adjusting closing entries. This is, we started out here. You take a look at purchases and beginning inventory, merchandise available for sale. Cost of goods sold goes to the income statement. Ending inventory goes to beginning inventory next time period, next month usually. We bought some more stuff from supplier, goods available for sale. Some of it we sold, some of it we kept. We got some adjusting entries, something called shrinkage. Shrinkage is also known as stealing, but not always. Think about it. If I expected to have, I have Walmart, we got 30 gallons of milk that we bought. We sold 20 of them. I expect to see 10 gallons of milk on the shelf. I go over to count the milk and I say, there's only 9 gallons here. That's shrinkage. We're missing a gallon. Well, did it go out the front door? Did somebody at the cash register said, you're a friend here, just run that through. I won't put it on the system. Did it go out the back door? Did somebody steal it? Actually, the front door was stealing too, by the way. Okay. Yeah, 100% off. That's another way of describing it. Or maybe someone said, well, we got a break room and I like coffee and I like milk in my coffee. And my boss, my manager said, go get a gallon of milk and bring it up to the break room. That's shrinkage. That's taking it for internal use. It's still shrinkage, but it's used up. It's considered a sale at that point. Or maybe, you know, you hear clean up on aisle 2, you just dropped a gallon of milk and it spilled all over the place. You got to mop that up. It wasn't on purpose. The customer dropped it. They're not going to pay for it. Company takes responsibility. There's our shrinkage. We're still missing a gallon no matter how you cut it. Okay. So we're looking at that shrinkage and we pull it into cost of goods sold. We assume it's sold, but we have 0 revenues to record. So our quadruple entry accounting is back to double entry. Okay. So we're going in and we're taking advantage of a single entry to reduce inventory and to reduce cost of goods sold. And marketing for store use, it depends. Okay. Use stored goods for work is making product for store use considered shrinkage. It is internal use. It actually should go to a different expense account is really what it should happen. It shouldn't be a cost of goods sold. It should be a cost of whatever department it goes to and charged to that department. So but in some smaller operations, yeah, just cost of goods sold, wash it. Let's bring it back here and be done with it. So that's where it goes. All right. So closing entries, I'm not going to worry about closing out to the income summary, but sales gets normally a credit balance. We debit it and close it to income summary. All the expenses, including discounts, returns and lines, and cost of goods sold, gets closed out to income summary. We close out income summary to retain earnings, and we close out dividends to retain earnings, reducing retained earnings. And that's the closing cycle. I'm not going to worry, not going to be tested. I'm not going to look at income summary account here. But I am going to be testing on multi-step versus single step. And let's take a look at this. I already told you that in our multi-step income statement, our 100% number is net sales. Okay, not our gross sales. Our 314.7 is our net sales, because our discounts, cash discounts, we're never going to get that money. Our returns and allowances, we're never going to see that money. So we want our 100% number right here next to our 314. Then we've got a cost of goods sold. We got a gross profit, 84.3. We got selling expenses. We got G&A, general administrative. I just call it SG&A usually. Income from operations, other revenues. Unless we're a bank, interest revenue and interest expense is something else. It's not mainstream. Unless we're a real estate company, gain on sale of building is something else. So bottom line, we got 14,000 net income. 12,900 is from operations, from our mainstream business, and 14.9 includes the extra $2,000 from selling a building and some interest adjustments. Okay. So there's our multi-step in full bloom. Here's our single step. All the revenues in one place. Sales, interest revenue, no matter what kind of company. Gain on sale of building, total revenues. Expenses, cost of goods sold, selling expenses, G&A, interest, total expenses, net income. Same bottom line. It's just we don't have a breakdown for cost of goods sold, which we really want to have. Tells us good information. Okay. And here's our balance sheet, classified balance sheet. I will mention that our balance sheet is an order of liquidity, turning things to cash or use up. So let's look at this listing here. Our current cash is most liquid, instantaneous. Accounts receivable, probably in the next 30 days, maybe 15 to 45 days. Merchandise inventory might take 60, 90 days to sell. Office supplies is over 12 months supply over the year. Store supplies, same thing. Prepaid insurance is usually over the year. So an order of liquidity is how we list our current assets. Okay. And then we've got something called an acid test ratio or quick ratio. So our acid test is our quick assets. Quick assets does not include inventories, does not include supplies, does not include prepaids. In this balance sheet, it will only include cash and AR. So our quick assets over current liabilities, our quick assets are much more, are smaller because we're eliminating inventory, eliminating prepaids. So we're going to have a smaller ratio than our current ratio, current assets over current liabilities. So cash, short-term investments, receivables, that's all that's included. A bank is going to use an asset test or a quick ratio rather than a current ratio because they don't know about the value of inventory. And that takes too long to turn over anyways. So that's the asset test or quick ratio that we worry about. Okay. And this is our asset test. Notice Nike, there's our current ratio 2.9 and an asset test of 1.8. This is compared to Under Armour. Under Armour is less liquid. Is that good or bad? Well, it depends. And finally, gross margin. We've done this. Sales minus cost of goods sold is net sales. You started telling me what the gross profit margin was on that income statement. And then we have our net income, which is net income divided by net sales. That's as far as I need and want to get today. Any questions that you have? Again, our review sessions will either be, you're welcome to all of them at 7:30 Thursday evening, 9:30 Friday morning, 11:30 Friday morning. Exam will be on Monday. You'll have the weekend to prepare. It'll be on chapters 1 through 4. Any comments or questions? Then I wish you a good week and a happy Monday. Thank you for your time and effort. Format for the exam will be similar to the quizzes, although in the homeworks. It will be on Connect, so you'll be accessing it, but it'll be mostly multiple choice, but you will have some fill-ins or calculations to do as well, like the worksheets you've done in the homework. You're very welcome. Thank you for asking. Good question. Hope to. Thank you. Appreciate the offer. Have a good afternoon. You will have a time constraint. You might say it's open book, open notes, but you won't have time to look in your books and notes. So just be warned. You probably will run out of time. I'll mention that again on Wednesday. little bit of stress. Thanks again for asking. Have a good week. We'll see you soon.